Now it's my pleasure to introduce to you the chair of the Greater Miami Chamber of Commerce Real Estate Committee, Alex Rhodes. He's a partner at Grant Thornton, whose 20 years of experience has put him in charge of the firm's construction, real estate, hospitality, and restaurant practice for the state of Florida. Thank you, Alex, for your leadership, and thank you for being a part of this chamber. It's such an active role. And let me turn it over to you now.
Great, thanks, Alfred, and thank you for the kind introduction. What I also like to do is take a moment here to thank Ocean Bank again, who's been truly a great partner of the Real Estate Committee and a supporter of ours. And you can see with Eddie's participation here on the panel as well, in the content of what we're trying to accomplish here. And for those of you that are new to the Chamber or to the Real Estate Committee, really the mission committee is an integral part of our community's real landscape. We hope to educate our members and really lead in the conversations on issues, trends, and developments that are impacting industry here in Greater Miami. And this event here is a big part of that. Like a lot of organizations, we've had to pivot this year. In a normal year, we usually have 4 to 5 meetings throughout the Greater Miami. We focus on a topical issue that's impacting the real estate industry. We encourage everybody to participate and speak up. For me personally, the committee is a great resource to understand really what's going on out there in multiple disciplines that are working here in our industry. Over the last 12 months, we really have 2 main events that we look at. One of which is the Developers Roundtable, which we held in November, which is a great preview of the Paramount Miami World Center. We had great speakers there, and then we're really poised to have a great our capstone event every year is the annual Real Awards and Real Estate Summit, which was to be held in April, and that's been pushed back like a lot of COVID impacted events. But really what I'd like to do is encourage all of you, to the extent that you're interested, to please reach out to myself, to Lizbeth Nunez, or Mark Haynes, my vice chair, to see how you can be involved. Like I said, part of the power of this committee is really getting and hearing from multiple folks that are working in the real estate industry and understand what's really going on out there. But again, thank you all for participating here today. Really excited about what we have in store for you. And what I'd like to do now is turn it over to my vice chair, wonderful vice chair, Mark Haynes, who will introduce the moderators. Thank you.
Thank you. Thank you so much, Alex. As Alex has mentioned, I'm Mark Haynes, Vice Chair of the Greater Miami Chamber of Commerce Real Estate Committee, and the Business Development Lead over at Coastal Construction. We're #1 in the state as far as a general contractor is concerned, and definitely #1 as one of the sole, only left, I think, family-owned and operated general contractor of our size here in the state. In any event, today I really want to thank all the participants on our panel, as well as all of our guests and members of the chamber chosen to join us on this day here in Florida. We've got 2 terrific moderators for today's panel. Our first I'll talk about is Catherine Amador. She's a partner with Berger Singerman's Miami office, a member of the business, finance, and tax team. Catherine concentrates her practice in complex real estate acquisitions, dispositions, and development, including multi-million-dollar buy and sell side transactions, financing, commercial foreclosures, and litigation. And then there's Javier Vasquez. He's also a partner at Berger & Singerman. He's a previous chair of this very same chamber, this very same chamber's committee, the Real Estate Committee. He's a gifted moderator, and as I mentioned, an attorney, concentrates his practice in the areas of zoning, land use, and general governmental regulation. He's an expert in public hearings and the public hearings arena, and Javi has represented numerous property owners with their approvals in this area. So with that, I'm going to hand it over to Javi, and Catherine, take it away, guys.
Thank you, Mark. Thank you to everyone. And once again, thank yous to the Chamber. Thank you to Ocean Bank. And we too at Berger Singerman are very excited about this panel. We're honored, Catherine and I, to be able to moderate. So to get things going, first of all, I'd like to introduce our 3 panelists today. First, we have Mr. Eddie Diaz, Senior Vice President and Head of Corporate Lending at Ocean Bank. Also joining us is Mr. Charles Foschini, Senior Managing Director at Brocadia. And last but not least, Ms. Arden Carson, Managing Principal at Carson and Company. And what I'd like to do at this time, before we start with the questions, is encourage each of our panelists to please give us a brief introduction, self-intro, and then we'll proceed with the questions. Why don't we start with Arden?
Okay, great. Well, good afternoon, everyone. Hope you enjoyed your lunch. Wish we could all be eating together, but I'm Arden Carson. I'm the founder of Carson & Co. We've been in business a grand total of, this is week 7, but I'm a South Florida native, grew up in the city, and I have been in the real estate industry for 25 plus years. Most recently, I was the senior managing director of CBRE, where I oversaw all of the operations for South Florida, 400 employees, 4 offices, 90 brokers, and a pretty extensive focus. Prior to that, I was a developer with the Related Group, and I'm very proud having developed Brickell Heights in downtown Miami. So throughout my career, I've been involved in so many aspects of the real estate industry. And in fact, Carson & Co. was born during COVID, when I was sitting home in quarantine and just trying to think about really what I wanted to focus on. And Miami is near and dear to my heart and my being, and I really wanted to be much more active and on real estate transactions. So I'm very excited to talk to you today about the things I've learned about the capital markets.
Thank you. Thank you, Arden. Charles?
I'm Charles Foschini. I co-run Bercadia's Florida operations, which is 6 offices across the state. Also manage my own production team. In a normal year, we do about $1 billion a year of financing with a group of clientele that takes me across the country, called Miami home since I came here as a student in 1983 to the U of M. And appreciate the opportunity to talk to you today about the deals we're seeing and how we're getting them done.
Thank you. Eddie Diaz.
Good afternoon, and thank you for having me on this distinguished panel. I've been with Ocean Bank now 15 years. Ocean Bank is a $4.3 billion bank founded in 1982. We have 23 branches in Miami-Dade and Broward County. Our primary focus is in commercial real estate, small, mid-sized businesses, and we also have an important area of international clients and wealth management. I'm very happy to be part of the committee, as I said, and look forward to a very nice roundtable.
Thank you, Eddie. So we'll get started with the questions to our panelists. I will be alternating with my partner, Catherine Amador, in the questions. And I'm going to start with the first question, which goes to the core of today's subject, being deals in a COVID environment. I'll start by saying that many of the deals that you guys are probably involved with today probably are still pipeline deals that originated pre-COVID. So the question becomes, how does the lending environment change as we start coming out of the pipeline deals and into the COVID era, if you will? And I'd like you guys, as you answer the questions, to kind of focus on all the different sectors of the real estate industry, which includes multifamily, retail, and industrial office uses. So Eddie, we'll start with you, perhaps from a community bank perspective, and then we'll get additional input from our other panelists.
Sure, thanks, Javi. So we are presently lending, and I think we will continue to lend into the future. As a community bank, we have intimate knowledge of our customers' financial situation, and we have a lot of track record with them. And we've kind of been through ups and downs together, have come out successfully on the other side. As far as the markets, office market is still a touch and go. The dust hasn't really settled on how businesses will look after this crisis, but we do see opportunities in medical office. Anyone that's had to visit their physician, Zoom doctor visits are less than ideal. So I think that there's potential there. We're seeing some activity there. The performance of our portfolio is really what's going to gauge our lending going forward. So our retail and multifamily portfolio has performed better than anticipated. We're getting reasonable collections. Even though there's freezes and evictions and there was a shutdown, people are performing, customers are performing. In addition to that, we're seeing a lot of transactions come through our community bank that typically go to large regional and money center banks. And that's provided us a welcome diversity for geography and products that we typically wouldn't see. But to answer the question specifically on new transactions, we're just requiring more equity and more reserves. We're stressing our cash flows with higher collections. And the biggest change really has been our boots on the ground. We see every property and we examine the tenants both existing and a potential tenant should a space go dark, and the ability of those tenants to continue to exist. So we're doing well. We're continuing to lend, and we're just being a little cautious.
Thank you, Eddie. Charles and Arden, feel free to chime in with examples.
I could go first and say that if you take a look at the stock prices of regional and money center banks, that's one reason why they're not as active right now. And then if you take a look at all the government initiatives with PPP money and some of those other programs, a lot of those groups sidelined and did that because it's highly profitable for them and they're not at risk with their capital. When I take a look at the capital markets for most of my clients outside the multifamily space, which also includes Freddie Mac and Fannie Mae, I have to look at money center banks, CMBS, life companies, and if it's a bridge loan, debt funds and Wall Street capital as well. I would tell you that each of those groups have taken a big step back and changed how they lend. And if you are a CMBS lender, you're in business today, but you're really in business to do self-storage, office, and multifamily. Freddie and Fannie are extremely active still in multifamily, rates well below 3% at some points, but they've changed their reserve structure, made it a little more difficult. Banks outside of the community banks that really look at the borrower and the local neighborhood are not very active right now. Life companies have stepped back in. We've executed a few life company deals this year. But they really are looking for best sponsor, best asset, lowest leverage, and that's typically multifamily or industrial in this market. And then a lot of the debt funds, they rely on banks to borrow money from the banks, lend it at a higher rate, and make the arbitrage. When those money center banks pull back, they also went to the sidelines. And if they have capital, they're very judicious about how they deploy it now. And there's a lot of folks really watching the next 90 days to see if some of our government programs are renewed and extended, or if there's going to be a market change again in employment and people's ability to pay the rent once those extinguish. So it's an interesting time right now in the capital markets. It's not an easy time at all.
Yeah, so I'll jump in now, and really, since Carson & Co. was born, I spend all day long talking to a variety of capital sources. I have some deal flow that really covers many different asset classes, so I've been involved in some really interesting conversations. So what am I seeing? Private lenders, bridge lenders, they're in the market. They want to loan money on land, high single digits, low double digits interest rates, 50% LTVs. So as Charles has mentioned, really looking for some, and Eddie mentioned some strong sponsors. But at the same time, they are willing to put money out. Some of the mortgage REITs, they have a ton of capital that they want to deploy. So they're looking to put out large, big chunks. One mortgage REIT that I spoke to who had been doing construction loans said, look, it's not that we're not interested in construction, we're cautious, but we don't want to put it out in drips and drabs. We want to write checks minimum $50 million. We don't have a lot of those deals here, but we have a few operating properties. So, that was actually encouraging to hear. Local banks, my conversations with some of Eddie's counterparts, I'm not going to necessarily say competitors, similar themes. They're very focused on their borrowers and the character of the borrowers, and they are looking for relationships. So that is really, really important. But they're also focused on single family homes, which I thought was very interesting. Owner occupied or spec homes, because what we're hearing about the immigration and people wanting their own private residence, I think that the capital is following those types of transactions. The large national lenders, they're wait and see, a little bit cautious, as Charles had mentioned. And the PE firms, they have raised a lot of money and they are interested once again, but it really just depends on the sponsorship. And then another capital source, which I've been following pretty heavily and I think is really interesting to sort of fill some of the gaps in the capital stack, are crowdsourcing. So there's a group that I've been watching, which is called CrowdStreet. and they've actually put it, and these aren't necessarily South Florida transactions, but to fill some of these gaps, because as the traditional lenders are getting much more, looking, not advancing as much money, there are these gaps. And I think some of these firms, such as CrowdStreet, are able to fill that. There's a lot of private money that's looking to invest in real estate. And this one firm in particular has been successful raising capital for about 35 transactions nationwide. So there is money out there for deals, just very cautious.
Thank you. Catherine?
Sure. Thank you, Javi. Before I ask the next question, I'd just like to take a moment to thank the Greater Miami Chamber of Commerce for putting this together. It's a great event and a great organization. And Ocean Bank, also thank you for being our sponsor. We at Berger Singerman, we're really honored to be a part of the chamber, and I'm personally honored to be moderating this panel with these prestigious panelists along with my colleague Javier, so thank you. We briefly touched upon this, but I'd like to ask the question, and Charles, if we can start with you. Do you anticipate a shift in levels of participation with respect to private equity versus institutional equity?
I think in the immediate term, which is now, a lot of institutions took a look at their horizon, which includes COVID, which no one had encountered before, which city by city has a lot of racial tension that popped up in the middle of this, that in November is going to have a major election that could have tremendous ramifications on how they deploy capital over a 5 and 10 year horizon. And they, in February and March, said, my year is over, and have really done nothing. And that's why you see so much sales activity that started the year quite robust just go to zero in almost every case and in almost every asset class. What that did was create a vacuum where private capital could look at the same lens and say, wait a minute, I have an opportunity to buy an institutional property and not compete for it, or not compete against the major institution that would always get picked ahead of me. And in the case of multifamily or industrial, where they have access to very, very good capital, one of the benefits of all the disarray we have at the moment, worldwide and locally, is that interest rates have come crashing down. So if you can borrow at a sub 3% rate at more or less the same leverage as you would do before, you in some cases might even be able to pay more for an asset and have a better yield to your investors. And when you're a committee of one as a private investor, or you're doing things through a syndication of like-minded individuals, you can often move much faster. So those are the transactions that we see happening. I expect that to continue at least through the spring of next year. I'm expecting by then just the amount of institutional capital that's raised every year will be under so much pressure to go out that the situation will reverse, and we'll see a lot of institutional capital coming back into the market. The other thing institutional capital has is options, right? So if you're a private equity individual and you own and operate a certain amount of real estate, that's what you do. If you're a major PE fund like an Oaktree or PCCP or any of those groups, HIG here in Miami, you could look at the same sector and start buying CMBS strips. You can start buying REITs that were impaired and trade stocks at a level that a private investor simply can't do, doesn't have access to B pieces of Freddie Mac's securitizations and things of that nature, and remain in real estate without actually buying and selling a single asset. So that's what's going on right now in the institutional world, and that is giving private equity a bit of an edge, at least for the moment.
Thanks. Arden, do you want to chime in on that?
Yeah, so I mean, I definitely agree. I mean, private equity definitely sort of has the edge, but I also, what I'm seeing is that the hold periods for some of these firms is being extended because they aren't able to sell, and so they're okay with sort of clipping their coupons to the extent that these institutional owners are in multifamily or they have well-occupied office buildings. So they're just delaying the sale of some of these properties. And I agree that a lot of this will open up probably the beginning of 2021. I've done, talked to a lot of folks who had properties on the market, they took them off the market, and they're just managing their assets and, just waiting it out.
Thank you, Arden. All right, we're going to move to the next question. I'm going to start with Eddie on this one. And I think this is a question that if I'm a participant on this webinar, this is the one I want to hear about. And it's investors are obviously trying to time the next opportunity market, the next distressed deal opportunity timing. So this is a timing question, which I'm posing to the three of you, starting with Eddie. Are we there yet? And if not, when do we expect this next distress run to happen? And as you answer this question, I'd like you to focus in comparing it to what we saw in the 08 run, and again, focus on the different markets. In 08, there was a big run on single family homes and residential. What do we see happening? When do we see it happening? And what markets are going to be most impacted? Let's start with Eddie.
Thanks. So luckily, we learned a lot of valuable lessons in the 2008 financial crisis, and that's permeated through my organization. Borrowers have entered transactions recently in much better shape than they were before. Higher debt service coverage ratios, all those things provide a cushion. So it's kind of delaying and giving time for things to kind of work themselves out. In my opinion, the most at-risk industry in South Florida is hospitality. There's been a lot of construction recently. There's been a lot of trades recently. And hotel properties are getting caught in their stabilization phases, and they're having to fight for market share. PPP loans, bank deferments, which we've done several, have provided a lot of assistance, but after that, there's not much more available. So if RevPAR doesn't improve in the fourth quarter, I think there's going to be some distressed opportunities coming up. Relative to 2008, a lot of our borrowers have more equity in the deal, and therefore they have a little more staying power. They're willing to put forth some capital to keep it going. And they also have a positive outlook for a quick recovery if and when a vaccine or treatment are available. So I think towards the end of this year, the beginning of next year, you might see some opportunities in hospitality and possibly in office.
And Eddie, before we take you off the stage here, talk to us a little bit about deferrals and forbearance agreements now and where you see that going.
Sure. So we were very quick to come out with deferral programs to offer to especially our hospitality borrowers. We were proactive in the sense that we gave them a significant deferral period in combination with capital contributions that took them into what we see or thought we would see as a recovery period, which is third and fourth quarter. It made no sense to do a deferral that ended in August when September is the nuclear winter of hospitality in South Florida. So we worked with them to get them into the fourth quarter. We also did 2,000 PPP loans. Many of these loans were to hospitality, both hotel, retail, restaurants, and that's really helping them out. And we'll see what happens. Some of these deferrals are going to come due soon, and unless there's additional guidance put out by the regulators or through GAAP, through FASB, we may have to just make some difficult choices and bite down on the bullet and continue the game. I think that's the idea. Time will eventually fix this. We just need to get there.
Arden, you want to chime in on the next distressed real estate opportunity?
Yeah, so obviously this downturn is, we're just in the early phases of, really trying to understand what's going on. And this one is has been caused by a healthcare crisis, not necessarily a financial crisis. So there's a lot of things that we need to understand. But what do I, having been in this marketplace for as long as I have, where do I think there will be some opportunities? I think there probably is going to be some sort of reset on land prices. I think there were a lot of purchases of land in what I would call more secondary and tertiary areas of South Florida that were priced because those would be the next frontier. And I think some of those land parcels and land deals, there's probably going to be some resetting. For those buyers who actually did use private loans, because most of those were financed with private loans, I think the lenders are going to be in a good position 50% LTVs, so most likely that will be okay, but there will be some sort of reset. This is very different because this is cash flow, and with retailers having issues paying, as well as restaurants, the jury's still out. Will there be an extension of the subsidies? We're hearing yes, at some level, but we're still so early in understanding the implications, but there definitely will be some buying opportunities. But I also think there's going to be some interesting development opportunities. And in fact, I'm working on a transaction right now, a mixed-use residential hospitality deal in Wynwood that actually is very forward-thinking and being built for the future with all the safety measures and things that people are thinking about when they make hotel reservations. Travel will come back. Already people are going to drive to locations. And so I am bullish on South Florida. That's why I'm participating in a chamber event. I truly believe that, we're in a very unique situation, and there will be buying opportunities, but at the same time, for all the reasons that we are here in South Florida, we will continue to be the epicenter in a positive way of investment.
Thank you. Charles?
Yeah, I would say, I mean, this pandemic affects everybody, and it affects everybody worldwide. So if you're looking for distress, it's difficult to find in the mid and long term, and that's where it's going to show up. I mean, it takes 2 years to foreclose on an asset in Florida when you want to give the keys back. So if you're reticent to do that, we'll probably be well past this by the time things correct. If you're taking a look at multifamily as an asset class nationally is holding up extremely well. Federal government came in right away with the CARES Act. Freddie Mac and Fannie Mae responded immediately as public-private lenders. HUD is still there. And so that's moving along very, very well. Industrial, which has been really the darling of the real estate industry in this cycle, accelerated to the center stage because everything now is logistics and movement, and it seems like that is only going to continue. So there's going to be very little, if any, distress there on a notional basis. When you step into the hotel world, I just came back from 2 weeks in Colorado, very socially distant, but I stayed in 6 different places. I only wanted to stay in one. The problem I had was all the hotels and lodges were overbooked because everybody wanted a socially distant vacation. And I plan to go to Colorado every year, but I didn't plan to stay as long as I stayed this year. And I think there's going to be a lot of unintended consequences in the hospitality space. If you look at some of the areas of the country, us included, that are in national and international news for behaving badly with COVID, it's because people are going to places they want to be and they're comfortable. And we're congregators as a society and a race, and we're going to continue to do that. Hotels are going to benefit. If you take a look at conference hotels and those much larger facilities or resorts that are destination only, they're going to be impaired, and they may have to totally change their business model to survive. So there is going to be some distress there, and that'll be measured over the next 1 to 4 years, my expectation. If you take a look at retail, retail has dramatically changed, but it was changing already. If you're in a very dense urban environment like South Florida is, I believe that retail get reinvented very quickly. There's plenty of schools in Miami that are overcrowded. If they need to open socially distant, maybe those end caps become new charter schools. And there's got to be a readaptive use to that I think will appear much faster than the stress stays. So I'm pretty bullish on us bouncing back over the next 1 to 3 years in a pretty quick manner. And I hope that there'll be opportunities, but I don't think there's going to be a pandemic stress like there was 2 cycles ago.
So quick comment before we go to Catherine with the next question. Just you mentioned about readaptive uses. As a land use attorney who is seeing applications both in the pipeline and being planned, I am seeing all of the municipalities in Miami-Dade County have to adapt, have to show some flexibility and reconsider some of the things that their comp plans call for, some of the things that their zoning map calls for, as a means of adapting to this terrible crisis. So it's interesting that you mentioned that, because that's something that seems to be very much at play here. So, Catherine, with the next question.
Sure. One of the ways that this pandemic has affected people, and it's affected our work life. Many of us are working from home and actually adjusting to work at home. So the next question wants to focus a little bit on the single family market. And if I could start with Eddie, I'd like to know if you are noticing trends in demographics, in geographic repositioning, and single family home purchasing.
We definitely are. It's being driven by two different things. First, the advantageous low rates. People are refinancing. Many people are refinancing to take money out to put in pools, for example, in their home. So our residential lending area has been very busy in 2020. But the crisis for Ocean Bank, about 50% of our workforce is working remotely. And I think that's pretty consistent throughout the country. And so what we're seeing is that this forced remote work environment has removed doubts of productivity. So that, coupled with people wanting to have Zoom meetings like we're doing today instead of in-person activities, has pushed people to come to different areas of the country looking for yards, open spaces, outdoor activities, a warm winter. So we're seeing a lot of relocations from the Northeast and the Midwest to single family homes in South Florida. That's all being driven by having the technology to be able to maintain your functions at your job, wherever that may be. And so you have the benefit of having both through the technology. Long-term effects are still up in the air. Those of us that have yards with pools have fared a lot better than those that live in condominiums, which had to close amenities for an extended period of time. And the other wild card is what's going to happen when the travel bans in Central and South America open up. Or is there going to be a rush of potential buyers looking for second homes or investment properties in South Florida? So it's definitely an interesting time for the single family home market.
So I'm going to jump in. It's not just single family homes. I mean, believe it or not, condo sales, I understand everything you're saying, Eddie, about amenities being closed, and I actually live in a condo. But I've been doing a lot of research recently, working with actually a lawyer from New York City who's looking to move down. He's a major partner from one of the big firms, and he only wants condos. He loves private elevators. He's looking for a boutique building. And when I call the agents who are working the for sale condos, they can't even get back to you. They are so busy right now. And so I asked the question, are these second home buyers, primary home buyers? And they're starting out as secondary. They want to live 6 months and 1 day here in South Florida, but they really want to figure it out. And so even though, yeah, we're in the epicenter, now using it negatively, of the pandemic, they're able to overcome that. I mean, a lot of these folks from New York, they saw it so much worse that hopefully we will see it. And so they're okay. They don't even ask those questions. They just want to be here, and they want to enjoy the South Florida lifestyle. They want to be on the beach. I mean, Miami Beach is now back in vogue. People only wanted to be, downtown, near Brickell, near, in Coconut Grove, Coral Gables. But I think all of these neighborhoods, they're just seeing just a burst of new interest, of renewed interest. And I think all of that is going to be so positive for South Florida and for Miami. So I'm very encouraged with all of that activity, not just on the single family home front.
Charles, do you want to add something?
Yeah, most of my business is commercial, but I do track the residential trends, because when people come down here, it's job creation, and that creates commercial opportunity. And it does seem that the realtors that I know that are in the rental business as well as the sale business can't stop picking up the phone with folks that are relocating down here and planning to transition at least their executive pool here, if not their whole firm over time. So South Florida could really be, and Florida as a state could really be a great recipient to that.
Charles, while we have you here, let me take you back to something you mentioned earlier. You touched base on Fannie Mae and Freddie Mac. We've talked about private financing, institutional financing. What do you see happening with government financing?
So, if you go back to their historic charters, Freddie Mac and Fannie Mae were created as people returned from World War II. And the theory was a stable populace would be a safe populace would become productive, and the greatest generation was born, right? So they really held to their charter when liquidity went out of the market and the entire world sheltered down. Freddie and Fannie very quickly came up with a forbearance program where if your municipality, city, or state prohibited you from evicting someone, they gave you forbearance on your loan. And it happened almost immediately and very much in real time. At the same time, recognizing the need for capital, they continued with their government-backed guarantees to lend, and to lend extremely well. They did change. They do now, when you close a loan, in most cases, have some type of principal and interest reserve as an offset. But you also have this forbearance program. As capital costs came down, they came down along with it, and you now have rates in the mid 2 to low 3% range for long-term financing. That allows an owner to have a much more profitable property. And when you have that extra cash flow, you can reinvest into the property, and that translates into a better renter experience as the world readapts to what may be an extended new normal. So, you know, I was very pleased to see Freddie Mac and Fannie Mae in their reaction, and in terms of continuing to be a reliable cost of capital, different than they were 6 months ago or even 4 months ago, but extremely responsive to the situation.
Thank you. All right, I think we are going to transition to questions and answers. We have some questions from our participants. Catherine, would you like to start with the first one?
Yes, here's the first question. How is the COVID-related pressure on the small business sector going to impact the viability of new anchored and unanchored retail financing deals? Who'd like to take that one?
You know, I could give an opinion to that. You know, if tenants go out, that's cash flow that leaves. It's really a math problem at that point. It's very agnostic, and it's going to be much more difficult to get a loan than it would be if that were full and the tenant worked its way through. Now, if you have an anchored center that's grocery anchored, or that's a health center that's healthcare anchored, or any of the essential services that have remained open, those spaces will probably perform well or be replaced very quickly with another tenant that sees that as an opportunity. I mean, the ability to get back into a restaurant space and not have to buy kitchens and grease traps and things of that nature, there's not a short list of tenants that look for that type of opportunity and will do well. So there'll be some short to midterm pain in the financing, but I think the long-term viability of those assets is still there.
Arden, anything on that one?
Yeah, I mean, I think capital right now for retail is really focused on grocery anchored. I mean, that's what I keep hearing. And a little bit of local space, but not a lot. But grocery anchored credit tenant. So we kind of get through this blip. But at the same time, we all need services. And I think looking at the stats, the historical stats for South Florida, Miami, we are quote unquote under retailed, believe it or not. And hopefully we'll be able to get out and start utilizing some of the services that we are missing.
Eddie?
We see mostly neighborhood shopping centers in the community banks. Maybe I'm a little bit over positive, but I've been very impressed with how small business retailers have pivoted and changed their business quickly and have made it work for the time being. And I think that's going to give them the time that they need to pull their way through this. There's countless examples in South Florida where I've seen businesses go from, you know, full in-house dining to delivery, full service delivery of everything you can possibly need. And so I'm very positive, and I'm very impressed with how the resilience of the small businesses down here.
All right, here's another question from our participants. Very, very good question. I'd like to hear from all three of you on this. We've seen a historic run for a while now with low interest rates. What happens with interest rates as a result of COVID? We'll start.
I'm happy to start off with that. You know, really speaking administratively and economically rather than politically, you know, this president picked out very early on that when you look around the world, our interest rates are much higher than anywhere else. And the spread between what our businesses and our commercial property owners have and our residents have that own homes is very different than when you go to Europe where they have negative interest rates, by example. And so there was a very strong administrative push to change that. And as an intermediary, I saw very quickly that, you know, in the last cycle, I was doing deals at 90 over LIBOR, but the LIBOR index was much higher. In this cycle, most of my deals were double-digit spreads, but the rate was lower. And so that told me it was a lot more profitable for the lender than maybe it had been in past cycles. I feel like all that's getting squeezed out of the system now. The administration and COVID is an accelerant to that. And my expectation is we're going to have low interest rates in this country for the very foreseeable future, which I would say is the next 2 to 4 years.
Yeah, my research says the same thing. So, you know, the good news is for real estate sponsors, interest rates will be low. And this is just a very unique time in history where hopefully we can get more capital out there so people can start borrowing and doing deals. But it's a once in a lifetime opportunity to take out loans at really favorable rates.
Eddie.
So I stopped trying to guess on interest rates a long time ago, but both of the panelists ahead of me made very good points. As a bank, we're trying to manage our balance sheet because we know that this is a long-term game. So we're just diversifying. We're doing a little bit of everything so that it averages out over time. But yeah, we're seeing historic rates, and I think they're going to be pretty low for the foreseeable future.
Thank you. Catherine, you want to take the next participant question?
So the next question comes from Alfred Sanchez, our chamber CEO, and here's the question. What will the long-term impacts be of the tremendous move into working virtually on commercial real estate? Do you see companies shrinking their footprint as leases come due?
Arden, you can start with that one.
I think the jury's still out a little bit. I worked a lot on this prior to leaving CBRE, and everything from users are going to need more space to less space. But for the short term, I think that many office tenants are just delaying decision making until people really get back to work and companies understand how do people want to work. They're just sort of delaying some decisions. Recently, I did actually hear about a law firm who was supposed to take some space in a new office building, and they ended up deciding that because working from home was working so well, that they decided not to take the full amount of space that they were anticipating taking. But at the same time, they are moving forward, going ahead and building out a big chunk of space. And so I think that is very positive. My intel is saying that a lot of the millennials, a lot of the entry-level people just starting out in the workforce, they really do want to collaborate and be in an office environment. And whereas working from home certainly was a novelty, it's challenging. People have kids and dogs and pets. So I think there will be some combination of working from home remotely a day or two a week and then going into an office environment. But people really do crave human interaction. And so I think that will bode well for offices and companies really maintaining a presence in our office district. So yeah, we still have some things we need to work through, but long term, I think we'll be okay.
Charles?
You know, I've been working remotely since February, I think. And for me, I have a mature business, I have a team, I have responsibilities. Business comes to me in terms of repeat business and referrals. And in that way, I can work from home almost as remotely as I can anywhere. But and a lot of my team that's relying on me to bring in the business to do what I need them to do to close the business, they can work from anywhere. And so in that way, we're just as efficient as we are before. But as someone that is in a leadership position, which involves going out and meeting people and generating new business and in a very competitive business, staying at the forefront of that, it's very hard to get hired on a new assignment with a new client that you meet on a Zoom. And it's very difficult even, to prepare to something like this. I'm adjusting my camera. It looks like I'm half asleep. I'm wide awake, but my iPad camera doesn't show me the way that I am in person. So, those types of things are very difficult, and that's anecdotal. But, if you're at any of us, think of our firms, CBRE, we're Arden Reference, 250,000 people. There's a culture there. Berkadia, someone put up one of their slogans, built for the now and the next. Very true. But that's a culture that took a lot of time to build and is continuing to be built. I'm a part of the fabric of that company, but the new person coming in as an intern or the lateral recruit coming in from another firm, how do they get assimilated into that culture? How do you build a firm of the strength of Berger Singerman and all the lawyers work remotely and don't interact and don't know each other? I believe over a very short period of time, that's going to test a lot of these remote workers, and we'll find ourselves back in offices as soon as it's safe to be it. And I would imagine that we're going to have, especially in the Southeast, so not just Florida, but the Southeast. I had a conversation with a lender that I do a lot of business with out of Boston. He says, I'm not going to the office. He says, why not? He says, well, it's 40 minutes by train, but it's 4 hours each way every day by car. And my wife is not letting me get on mass transit. And, we live in Miami, and it's 18 minutes from my house to my office by Metro Rail, and it's 30 minutes by car. Both are very doable and neither interfere with my day. But imagine if we had to drive 8 hours for an 8-hour workday. That's not going to happen. So in the Southeast, I believe we're going to be a net recipient of office space as people in highly dense urban areas like New York, like Boston, that also have very different tax burdens and also have very different administrative policies as to how they can conduct their business. And that's been highlighted in this pandemic. We're going to be a net recipient to job growth. And in most areas of Florida and the Southeast, which are still relatively suburban and rural by comparison to Miami, you can get in your car, leave your beautiful home, drive 10 minutes, park in a covered parking spot, and walk into your office or take 2 flights of stairs to your office. That's a very different experience than anyone that's ever worked in Manhattan. And we'll be a net benefit of that. I believe the office space will be a net benefit of that. It'll have some growing pains, but it'll grow very well.
So we have time for one more question. Eddie, did you want to add anything on that subject?
Just from our perspective at our organization, we've seen a development of hybrid positions. So I think office space is going to continue to be necessary. I think it might look different. We're going to have more collaboration areas, more shared spaces. But as the other panelists mentioned, at least in my industry, you learn by being around and watching kind of how things are done. And in order to develop the future, we need to have those people collaborating with us, seeing what's going on, and learning the ropes as they come up. You can't plan an impromptu meeting with a client that walks in with a deal. So I think that we're just going to see it look a little bit different with more collaborative space and more flexibility and hybrid positions.
So last question before we turn it over to our committee chairman, Alex Rhodes, to close this out. And I will start with Eddie from a community institution perspective. And a lot of the interest as it relates to the questions from our participants has to do with commercial real estate. So here's it's actually a combination of 2 questions. Are we not certain to see commercial real estate prices drop? will demand for space be permanently be reduced such that prices will have to fall? And if so, will not loan to value ratios be permanently affected, driving commercial foreclosures? So a lot packed into that question. But again, from a community bank perspective, Eddie, you can start, and we'll hear from Charles and Arden after that, and we'll close it out.
I think eventually there'll be an impact, reduced occupancy in retail and restaurants, and will have an impact. You can't, if you have 200 tabletops at a restaurant and now you went down to 50, you can't continue to pay the same rent going forward. So I think that the valuations will be affected more than anything because of the net operating cash flow from the rents. Rates are low, so cap rates are kind of like defending against that. It's really time will tell. Nobody can, I mean, I don't think anybody can really see what's going to happen that much further into the future, but there are pressures there on cash flow because tenants can't pay rent if they're operating at 50% capacity.
Arden, then we'll close with Charles.
I mean, I just think it's too soon to tell. You know, clearly lenders are foreshadowing some type of decline in values, which is why they're not going to be putting out as much money on deals in the short term. I think that's another reason why there's a bit of a bottleneck as well, because it's just really hard to get your arms around value, not knowing what tenants are going to really be able to afford to pay, because the rules sort of keep changing and what are going to be the permanent rules. So it's a little bit of a wait and see. And you know, even for some lenders who then ultimately end up securitizing loans, which take another 30, 60 days. I mean, a tenant that's a major occupant of an office building that's paying today, who knows what they're going to be doing in 60 days once the PPP is finished, and if there's no extension. So I just think there's just a little bit too much uncertainty. You know, yes, it seems like forever that we've been in this so far, you know, since March, and it's been months, and we expect it to be weeks. But, you know, I'd love to see where we are and answer that question again in a few months. And, you know, it'll be interesting to track and monitor.
Thank you. Charles.
You know, I believe that over time, you know, real estate is a very sticky, it takes 6 to 9 months to sell a commercial asset. So you can't look today and predict tomorrow as well as you can with a stock that's instantaneous. I expect that you may even see cap rates go lower in the winters. Certainly industrial looks like it's going to be that way. Multifamily, especially with the backstop of Freddie and Fannie, who's the dominant lender in the space, looks to be that way. And it's an asset that people have to use. You have to live somewhere. When you take a look at the hotels, and if you subdivide that between conference center and destination driven hotels versus staycation type hotels, I believe the staycations may come out actually a bigger winner. You know, I was in a Hilton during my course of trip in Colorado, and they're doing it right, and they're doing it very quick. You've got a grab and go concept, so it cuts the breakfast cost by 80%. They don't give room service or anything like that anymore. That's an expense that goes out the window, and customers are happy with it because I don't want anybody in my room right now. And you walk in and it says it's been sanitized with a stay clean, and you're the only one that uses that. So I think the net to the bottom line is going to be better for some of those hotels as the market comes back. Retail will be the big challenge. There's got to be some readaptive use. Eddie talked about the model. You know, if you're a sports bar, you don't make your money when you and I meet for lunch for half an hour. You make the money at night when we're standing shoulder to shoulder with 2,000 fans that we don't know, all drinking beer for $1 that costs a nickel, but there's no sporting events. So no one's going to do that, even if we could do it without social distancing. So I would say the biggest pain and the most material change in how cap rates are analyzed in the long term will be for conference center hotels and resorts, and for retail that's dependent on neighborhood and concepts that just don't work well anymore.
So Charles, Arden, and Eddie, thank you. You guys have been spectacular. On behalf of Catherine Amador and myself, thank you for giving Berger Singerman the opportunity to moderate this panel. Without further ado, I'll turn it back to our staff, and wishing everybody that participated on this webinar a very happy afternoon.
Thanks, Javi, and thank you all for attending. And thanks again to our panelists, Arden, Charles, and Eddie. Tremendous job, guys. I think we covered a ton of ground here, and I'm sure we could have gone on for the rest of the afternoon with all the uncertainty that's out there. I mean, a couple of themes that really stuck out to me, the strength of PE capital in the market. Obviously, I think, Charles ended with it, the challenges and opportunities facing both the hospitality and retail markets. The encouraging strength, I think we all heard in the residential markets, whether it's single family, condo, multifamily, and the opportunities that those provide for us. I think also the challenges facing our smaller businesses. I know Eddie touched on that. Restaurants, for example. I know I've worked with a restaurant group that really, from the beginning, is only taken on second generation restaurant space, and so it sounds like maybe there's going to be more opportunities for that to happen going forward in the future. We touched on historically rates, and of course, the uncertainty that's here in the market. I mean, as I had mentioned, we could be back here in a few months and the answers to these questions could be completely different depending on how the market goes. But great job, guys. And I have to say, as a personal goal, as an audit partner at a CPA firm, having one of our panelists talk about generally accepted accounting principles was one of my goals during my tenure. So thank you, Eddie, for that, for bringing that up during your portion of the talk. And also, thank you again to Javi and Catherine, doing a tremendous job as moderators. Having been involved in both, in-person and virtual events. Obviously, moderating a virtual event has got its own unique set of challenges, and I think you guys did a great job. And so, great job, tremendous job to both of you. And then I also want to say thank you to those that attended. As Ard mentioned, I think at the outset, we'd much rather be here with you in person, having lunch with you, having this conversation, building those relationships. I know we touched on it. I think Charles and Arden did a tremendous job of kind of articulating it, the value of meeting in person and developing those relationships. And so I'm hopeful, not just as an industry participant, but just as a business person and as a person, that we continue the opportunity to have these, personal interactions. I think they've been referred to as collisions, or kind of the serendipitous encounters where you run into people. I think there's a lot of value to that, and so hopefully, in the near future, we'll be all collaborating, closely together. And finally, I'd like to thank again our sponsor, Ocean Bank, for helping continue to be a tremendous supporter, for making this possible, and for the folks at the Chamber. And again, I hope all of you take the opportunity to be involved in the Chamber. I think for the near future, we're going to be having our event virtually, so definitely reach out to myself, Mark Ains, the Vice Chair, or Liz Nunez, and think about how to get involved. And we'd love to have you. So thank you all, and hope you all have a great afternoon.
Thank you.